Every time you get a paycheck, you expect to see a significant portion routed directly to the government. But for the absolute wealthiest individuals on the planet, the math works a little differently. In fact, their true tax rate often hovers right around 0%. Take Jeff Bezos. Between 2006 and 2018, his wealth grew by over $120 billion. Yet in 2007 and again in 2011, he legally paid $0 in federal income tax. Elon Musk managed the exact same feat. In 2018, despite sitting on a vast fortune of Tesla stock, his federal income tax bill was also zero. They achieved this through a bedrock rule of the U.S. tax code, known as the realization doctrine. The IRS only taxes realized cash income, like a biweekly salary, or the profit from selling an asset. They do not tax the rising paper value of unsold stock. This creates a strange financial reality. If you are a founder and your wealth exists entirely in appreciating shares of your own company, you are technically, legally, income-less in the eyes of the government, which raises an obvious question. If billionaires have no official income, how do they actually pay for the super yachts, the mansions, and the daily expenses of a luxury lifestyle? They use a hidden mechanism called asset-backed borrowing. It allows them to extract liquid cash from their paper wealth without ever triggering a taxable event. To see how they extract cash, look at this diagram mapping out a standard billionaire portfolio. Instead of selling their shares and triggering capital gains tax, they use those shares as collateral to secure massive, low-interest cash loans from major banks. Here is the crucial loophole. Because borrowed money is a debt that must eventually be paid back, the IRS does not classify loan disbursements as income. The cash loan bypasses the tax barrier entirely, arriving in their accounts 100% tax-free. They repeat this process until they pass away. At that point, the die phase kicks in. Their assets are transferred to their heirs with a step-up in basis, a tax rule that legally wipes out the accumulated capital gains liability upon death. This buy, borrow, die strategy allows the ultra-rich to endlessly consume wealth without ever contributing to the tax base that sustains the country. Lawmakers in Washington have taken notice of this discrepancy. Senator Ron Wyden drafted a radical overhaul known as the Billionaires Tax to close this exact loophole. The proposal is highly targeted. It is designed to apply exclusively to roughly 700 of the absolute wealthiest taxpayers in America. The core mechanic of the legislation relies on mark-to-market taxation. Instead of waiting for an asset to be sold, the government would calculate and tax the on-paper gains of a billionaire's assets every single year. This would act prospectively on all future growth, but it would also hit them retroactively. In the first year, affected taxpayers would owe taxes on all the unrealized gains their assets had accumulated since they were first acquired. The intent is straightforward. By taxing the underlying collateral before it can be borrowed against, the government aims to permanently break the buy, borrow, die machine. Implementing this tax requires the Treasury to distinguish between different types of wealth. Officials would have to separate transparent, tradable public assets from non-tradable private assets. While public stocks have clear market prices, the Treasury would have to subjectively value and tax illiquid assets, such as private real estate empires or massive art collections, on an annual basis. This creates a significant investment bias. To avoid the tax on public stock, billionaires would be incentivized to move their capital into opaque, volatile private markets, where valuations are harder to track. Rather than cleanly capturing wealth, this shift could encourage the ultra-rich to obscure their money in the less transparent sectors of the economy. There is a mechanical mismatch at the center of the billionaires' tax. The IRS requires payment in cash, but the tax is assessed on paper wealth. Mark Zuckerberg serves as a case study for the liquidity problem this creates. Zuckerberg owns over $100 billion worth of Facebook stock, almost all of which is untaxed capital gains. If he is assessed a $30 billion tax bill on those unrealized gains, he doesn't have that amount of actual cash sitting in a bank account. To pay the government, founders and billionaires would be subjected to forced liquidation. They would be compelled to sell off massive blocks of their controlling stock in the open market just to generate the necessary cash. The government would essentially be mandating the rapid conversion of billions of dollars of paper wealth into hard currency across the entire billionaire class. When hundreds of billionaires are forced to liquidate simultaneously, the market must absorb a massive influx of sell orders. As supply overwhelms demand, the price of these blue-chip stocks drops. This sudden drop in price can trigger panic selling among other investors. Simultaneously, the billions of dollars leaving these stocks to pay the government suck away investment capital that would otherwise fund growth in other sectors. That disruption hits the 401ks and retirement portfolios of middle-class Americans who own those same public companies. A tax meant for the ultra-wealthy could inadvertently devalue the savings of everyday workers. Some economists suggest a narrower alternative, taxing the act of collateral borrowing itself. This would target the specific mechanism of tax avoidance without requiring annual valuations of unsold assets. The buy, borrow, die strategy represents a significant gap in how the tax code treats different types of income. However, taxing unrealized gains creates a risk to market stability, a cure that might prove as disruptive as the problem it aims to solve.